Ever since money was invented, different nations have had different currencies. Exchange rates are the price of one nation's currency in terms of another nation's currency. If you travel to Europe, you'll need to exchange some of your US dollars for euros. At the time of this recording, one US dollar bought you 0.86 euros, or equivalently 1.16 US dollars, or $1.16, bought you 1 euro. This is the exchange rate between US dollars and euros, and it applies both ways. If you come back from your trip to Europe with some extra euros in your pocket, you would be able to exchange each one for $1.16. Different currencies have different values. $1 might get you only 0.86 euros, but it will buy you more than 112 Japanese yen. Likewise, 1 Japanese yen will get you less than a US penny. These exchanges happen in markets for currency, and they're an important step in international trade. If someone in the US wants to import some Japanese cars, they're going to need to convert their American dollars into Japanese yen. These days, it's very easy to find buyers in that market, as there are many people in Japan looking to trade their yen for dollars in order to buy some American goods or to invest in the American economy. Nations have options about how they approach these exchange rates. Most modern countries have a system of floating exchange rates. They allow the value of their currency to fluctuate based on the market. A domestic currency appreciates when it buys more foreign currency. This is great for importers because an appreciating US dollar means foreign goods get relatively cheaper. A domestic currency depreciates when it buys less foreign currency. This is great for exporters because it means our exports become relatively cheaper for foreigners to buy. Keep this in mind the next time you hear someone bemoan a falling value of the dollar. In my experience, most people who are upset about a depreciating currency think it spells doom for US businesses exporting goods and services abroad, when in fact, the opposite is true. Alternatively, a country can embark on a policy of fixed exchange rates, where the country maintains a consistent exchange rate with another currency. Until 2005, and again for a while until 2010, China maintained a fixed exchange rate with the United States. This meant that China had to keep a tight control on their own monetary policy and enact capital controls, which prohibited capital outflows to maintain a steady exchange. The upside is that it helps facilitate international trade between the two countries by keeping relative prices stable. From the late 1800s until around the 1970s, countries had an on-again, off-again relationship with the gold standard, where each country fixed the value of their currency to gold. From 1958 until 1971, for example, US dollars were convertible to gold at a fixed exchange rate of $35 per ounce. That means you could take $35 to the US Treasury Department, and by law, they had to give you 1 ounce of gold in exchange. If many nations all fix the value of their currency to the same thing, like gold, their exchange rates become fixed. As it did with China, this helps promote trade between nations, which can be good, but it comes with the trade-off of potential financial calamities, as we'll see in later chapters. Fixed exchange rates can be hard to maintain without political discipline, and markets will ensure that whether fixed or floating, systems of exchange rates are equivalent across the board. Here's an example with real data. I can take 1 US dollar and convert it to 0.86 euros. The exchange rate between euros and yen is 130.88 yen for every euro. So 0.86 euros buys me 112.56 yen. And 1 yen will get you 0.0089 US dollars, which means 112.56 yen gets me $1. If you send money through a bunch of currencies, it should return as the same amount. Actually, you'd end up with a lot less because you'd be paying small fees for each exchange. But you can see that the rates still work out. But what if Japan decided to suddenly fix their exchange rate so that 1 yen got you $1 and vice versa? Well, now I can convert my dollar to euros and euros to yen, netting me 112.56 yen, just like before. But now that 112.56 yen converts to $112.56. Holy schmoly, we have ourselves a money pump. We could just keep sending money through until we're the richest people on earth. This is called arbitrage, and there are many currency speculators who buy and sell currencies where the exchange rates don't line up. Of course, in this scenario, we would hardly be the only ones who notice and send money through, and this massive increase in the demand for euros and yen will quickly cause an adjustment in the market prices. Of course, currency isn't the only thing with an opportunity for arbitrage. Differences in the prices of goods and services can also be exploited. Take these Big Macs, for example. A Big Mac in the US cost $3.99, at least at the time of this recording, while in Britain it cost £3.19. Based on those prices, we would expect that 1 US dollar gets you about 80 pence, or 0.8 pounds. But in the market, you only get 74 pence for your dollar. That means that Big Macs in the UK are relatively more expensive than they are in the US. And you could make some money if you could just figure out a way to get US Big Macs to the UK and sell them. That might be a little difficult, but this sort of thing happens all the time with other goods and services. We just call them imports and exports. But this Big Mac index, where we compare the prices of Big Macs across countries, which is a real thing, by the way, that fully fledged, real, important economists actually keep track of, helps us compare something else, the cost of living. A Big Mac has lots of ingredients from all over the world, as well as lots of ingredients that are sourced locally. If we had to pick one thing, it's not a bad choice to represent the entire cost of living in a particular place. But we can do better. Purchasing power parity is a theoretical exchange rate that allows you to buy the same amount of goods and services in every country. We already know about the Consumer Price Index, which tracks the prices of a basket of goods in a country in order to monitor for inflation. Well, we can also compare identical baskets of goods between countries and see how the cost of living differs. In this chart, on the right is the nominal GDP for each country. Since it's all from the same year, 2018, they're comparable to each other, and we can see that from a global perspective, US GDP was much higher than China's. But on the left is GDP by purchasing power parity. Because prices in China are so much lower than they are for the same products in America, China's GDP is actually higher than ours. That is, they can afford more stuff with all their income than we can, even though their income is lower than ours. Of course, this is GDP and not GDP per capita, and China has 3 times the population of the US to split that income among. Nevertheless, purchasing power parity is an important metric when comparing countries.